Welcome, everybody. If you weren't awake, you are now. Welcome to the Brentwood Rotary Club on March 18th, 2022. It's not currently raining. It may be raining, but it's still a beautiful day to be in Brentwood, Tennessee. Thank you so much. First of all, on a very sad note, I'd like to report that Joe Regan, our former mayor, passed away yesterday. And he was in his mid to late 90s. Finer man I've never known. He was a good mentor for me. And if you would keep his family in your prayers, I would appreciate that. Amazing man, had polio as a child and did nothing but service for the rest of his life. So this morning, we're going to have the prayer by Ellen Treadway and four-way test by Sybil Buchanan. So
well, I don't know if you need to bow your heads. This is a poem, and I'm not going to make this about SEC football, but my grandfather gave me a poem when I was little, and I lost it. But it was a poem that Bear Bryant read every day of his life. And listen to the words. All right. This is the beginning of a new day. I can waste it or I can use it for good. What I do today is very important because I am exchanging a day of my life for it. When tomorrow comes, this day will be gone forever, leaving something in its place that I have traded for it. I want it to be good, not evil, gained, not lost, success, not failure, in order that I shall not forget the price I paid for it. Amen.
Okay, so if everyone would put your hand on your heart and join me in saluting the greatest flag in the world. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all. And now join me as we recite the Rotary four-way test of what we think, say, or do. Number one. Is it true? Number two. Is it very well concerned? Number three. Will it build goodwill and better friendships? And four. Will it be beneficial to all concerned?
and number 5.
We certainly hope so.
Thank you, Linus. In the spirit of spring break, with so many of us being gone, we do have people that spend their spring break with us. Thank you, Laura Troop, for visiting us one more time. We appreciate you. Laura was here last week and has come back to visit again. Other than that, I don't think we have any more visitors today. And thank all of you for coming today. Oh, we do have a visitor today. Jason's brought our buddy again. Hey. Spring break after all, right? We have Sherry doing happy bucks today. So anybody happy, let her know. All right, Larry's happy.
Where's my little thing?
Right up here.
Oh, do I need a microphone? I mean,
Not really, but you do for Zoom.
There we go.
There you go.
You pretend money. Two things real quick about the golf tournament. We had a great first week, We've had a second week. So let's don't lose our momentum. If you've got sponsors from last year you hadn't called yet, call them. I mean, this is the time to be working on them and getting them in. Like I said, we had a fabulous first week. Our first week was so good that we have 0 playing spots in the tournament left.
Oh, yeah.
So don't tell anybody when you're selling them or talking to them that they can come play in our tournament. We have no spots available. Now, that's not unusual. That's a kind of a good problem to have, but I just don't want, we've had one situation here just recently where somebody told somebody they could play in the tournament. I had to tell them they couldn't. We can only have so many players, and if you get too many, it ruins the day for everybody. So we're not going to do that, but we don't have any spots available. Just remember that. And please get out and contact your sponsors from last year. We got a lot of them hanging out there. Thank you.
And as a kind of teaser, I will direct your attention to the last quote of the day. I'll just leave it at that.
Mine's not necessarily happy, and it touches on what Mayor Crosley did, but Mayor Regan was a great man, a great servant. He's not a Rotarian, but he epitomized service above self. I was blessed to serve with him for 2 years, knew him many years before then, and also saw him serve and be very active in our community after he retired from being a commissioner. But he's a really good man, a really good mentor to me, as Betsy mentioned. I remember when I first went into office, there were many times he would instruct me on different things of how to do something or not do it. He could have let the young commissioner really embarrass himself, but he never did. And I think it's only appropriate, a good Irish Catholic, he entered heaven in his perfect healing from this life on St. Patrick's Day. So
Yes.
many of y'all probably never knew Joe, but Joe was a good man.
And yeah, his wife Betty also served as a commissioner. Now they're together.
I'm putting $2 in because the number 2 seed Kentucky got beat by St. Peter's.
Oh, where's Skip Hebert?
Anybody else happy about that?
Even with the March Madness theme, unfortunately, my Dayton Flyers did not make the dance, but they are in the NIT. They're playing Vanderbilt on Sunday. So I don't have any Vanderbilt alumni, but go Flyers.
Anybody else?
I will owe some money. I am very, very happy because I'm going to be a grandmother again in October, y'all. My youngest Rob is on his second. So little Charlie, who's 3, will have a brother or sister in the meantime. We, of course, lost a good friend here with Bernie, and Elizabeth sent us a quick note. So I'm going to go ahead and read that to you because it's very sweet. Dear Rotary Club, thank you so much for the beautiful orchid. Bernie loved the Rotary Club, and when we were traveling the world, he always took time to attend Rotary whenever we were. The Friday before he went to the hospital on Wednesday, he Zoomed with y'all. Thanks for all you meant to Bernie, Elizabeth. So I thought that was just really sweet. Julie, you have an announcement for us. So good.
So Pancake Day is April 23rd. You have sign-up sheets on your table. If you have not signed up online or sent Jordan an email, you can use these sheets to sign up. Also, if you aren't planning on helping because you're gonna be out of town or whatever, will you also put that on there, because that way you won't get a phone call, and no one wants a phone call from Sarah Johnson. Let us know also if you're not going to be here. That would be very, very helpful. If you guys have any questions, Jordan's here, I'm here. Jane and Sarah, I think we're out of town.
And along those lines, I'm going to use my teacher voice. I'm going to invoke my teacher inner self. And that is, this is a requirement for the club. And don't just say, oh, I've got something else to do on Saturday. There's a great baseball, basketball, whatever. You can spend one shift at least. In fact, you must spend one shift at least if you are in town. It's part of what we do. It's like the golf tournament. So please remember that and make sure that you choose a specific, if you want to choose a specific thing, Jordan's taking your orders right now. This is the time. Otherwise, we're going to come to you with Sarah or me or Julie and say, so here's what we have left. Which one do you want? So it behooves you to go ahead and sign on up early if you could. And along those same lines, I'm still being a teacher. Y'all sign up for the food. Larry was going, oh, I think we're going to be okay. I'm not sure. But if you know you're coming, it takes 1-2 punches of the button and you're here. You get the email, just punch the button twice. All right?
You don't want Larry counting potatoes.
No, you don't. All right. And somebody told me, said, what I need to do is just call everybody to the front that didn't sign up and line up and give them a piece of bread and say, this is all you get. So don't make me do that. That would not be good. All right. We don't have a slide for Rotary Moment today, but I would like to tell you a little bit about what's going on. Dan Jordan has given us a wonderful piece of information that he actually has been friends with the man who is currently the president of the Rotary Club of Kyiv, Ukraine. It's pretty amazing. And the man has written us, Arthur has written us and said, these are the ways that you can help. Well, there was a lot of direct things back and forth, and we were just sort of worried about the logistics. So I reached out to the folks at district, and now it's going through the district. And in fact, it's actually going to zone 30. So perhaps we're going to be able to get a good bit more for them in a good way through Rotary. And we'll be filling you in as to how maybe you can help with that if you can. One good thing is Rotary has a disaster relief fund that is available for any Rotary Club all over the entire world. So the Rotary Club of Ukraine, Kyiv, Ukraine has applied for that, and they should be getting that $50,000 grant as soon as possible. They'll be using that for medicine and health issues. So just want to update you on that we are going to have an impact. And for those of you who are concerned about wanting to do something, this is one way we're going to begin to do something. So, all right. Anything else? All right, Jeff, are you ready?
I am ready.
All right, well, I'm going to introduce you then. Jeff Brown, one of our members here, was born and raised in Salt Lake City, and so he knows how to ski quite well. Brief periods in Idaho, he received his BS in economics from the University of Utah and his master's from the Anderson School at UCLA. Most of his 45-year career was focused on business, economics, principally in the energy industry. He describes himself as a blue-collar, quote-unquote, economist, providing decision makers with actionable information rather than academic research. He's been a project developer on numerous gas-fired power plants and was the lead developer on the Baja Norte gas pipeline, the first export pipeline to Mexico. For the past 10 years, he served financial advisors with investment research, asset allocation, and market monitoring. His work combines macro and microeconomics, helping his clients connect the economy with financial asset performance. Jeff's been a Rotarian since 2010, serving as faculty for Rotary Leadership Institute, RLI, Zone 33, among other areas of service. He's going to review the fourth quarter and full year 2021 economic performance and asset values and returns. So with that mouthful, Jeff, welcome.
Great. Thanks. Nice to be with you. I'm sorry I can't join you in person. I woke up Sunday morning with a badly swollen leg that turned out to be a blood clot. The doc had said to stay off of it for as much as I can. So that's why I'm doing this via Zoom. But things are going well, and I'm on the recovery. I'd like to make this as a briefing more interactive and conversational. So if you have any questions, put your hand up and Linus will get you a microphone, and we'll make this more of a dialogue than a lecture, because I hate lectures as much as anybody else does. So anyway, start off with this graph shows real GDP growth in the red bars for the last 16 quarters, and the 4 brown bars are forecast for the coming 4 quarters. Those are principally by the Wall Street Journal Survey of Economists, and they have been among the more accurate of the forecasting things that we've seen in the past. And by the way, don't worry about reading the headers at the top. I'll send anybody who wants a copy of these slides. But a couple of things to point out is that the big drop in GDP that happened in Q2 20 was more than made up for by the end of Q3. So the COVID recession was a very short-lived, although a very dramatic decline in GDP. So growth was a little higher in the fourth quarter, the 6.9% than was predicted, but expectations now for the following 4 quarters are not so robust. This is this chart is one that I have used for the last 10 years, and it's been a pretty accurate predictor of recessions, as you can see in these two gray bars here. There are two lines here. The leading economic indicator is comprised of 10 components. We'll talk about those in a little more detail in a minute, that allow the conference board who puts this together to project what the economy is likely to be doing in the future. The red line is the current economic index. And one of the things that is of note here is the gap between them and the different slopes in those two curves, which says that the economy is slowing down. The current economic index is not growing as fast as the leading economic index. So we'll see how this plays out. But in the past, it's been a fairly good indicator of what reality is going to turn out to be. This chart shows the 10 components of the LEI. Not content to look at just what the graph itself shows. I like to get into the internals and look at what's actually happening. And the 10 components of the average weekly hours worked. The trend for this is down, which is a moderate to weak growth signal. Average weekly unemployment claims is basically neutral. Manufacturers' orders for new consumer goods is slightly up. The Institute for Supply Management, their index of new orders has been weakening a little bit over the last couple of quarters. Manufacturers' new orders for non-defense capital goods has been increasing, and it shows us a positive trend, upward trend. But one of the more surprising ones is building permits. This has been a chronically weak part of the economy for the last 5 quarters, and now it's showing pretty strong growth. So housing is one of the real bright spots. Of course, the S&P 500, the stock prices, has been a real engine of growth for the economy for the last couple of quarters, but it's weakening now. And so that's an indication that perhaps asset prices are not going to be as strong as as they have been in the past. The leading credit index is an artifact or a proprietary indicator that the conference board has put together, and they don't publish how they put that together. So this is one of those areas where I have to get a little bit creative. And so I built my own, well, not really built my own, but I've found a substitute in the St. Louis Fed's Financial Stress Index. And this has been consistently strong due to the low interest rates that we have experienced. I expect that this is not going to look so good in the future. The interest rate spread, this is the 10-year Treasury less the federal funds rate. Now, the federal funds rate, and we'll talk a little bit more about that in a second, is the rate at which banks lend to each other overnight. And so it's the shortest of the short term, whereas the 10-year Treasury is basically the longest term of a widely traded fixed income interest rate. And what this indicates is that there should be a premium that investors are paid to lend long as opposed to lend short. And so when we have a nice healthy spread between the long-term and the short-term rates, that's an indicator that things are going fairly well. The one area that we're seeing that has really taken a tank in the last couple of quarters is consumer expectations for business conditions. Now, since consumers represent 2/3 of the economy, this is a real troubling indicator. Consumers are not happy about where things are going, and they're pretty disappointed about what's happening. So this is at historic lows, and this is something that I watch very carefully. And hopefully this will not turn out to be too much of an indicator of a recession, but right now that's really where it's pointing. Can't talk about GDP too much anymore without talking about inflation. In this graph, we have the consumer price index going back to 1960 out to through the end of 2021. And along with that, we have the federal funds rate, which is the green. These gray bars represent recessions that have occurred throughout this history. And one of the things that's really important to note is that interest rates in the form of the Fed funds rate really has to rise above the CPI to knock inflation down. So this is the early 70s recession, had a pretty steep increase in Fed funds rate. This increase in the mid 70s wasn't higher than the CPI. And although there was a reduction, it didn't really put the fire out. It really took Paul Volcker here in the late 70s to really jack interest rates up to as high as 16% to really start the trend moving downward. But you can see that inflation has been kind of persistent. It tends to want to keep coming back, and it took a real long time for it to get down to this 2% level, which is the Fed's target rate. And it wasn't really until the 2000 recession that we really got it under control. So the whole idea that inflation is transitory or could ever be transitory, to me, is one of the most ridiculous things I have heard come out of the Federal Reserve. And not to get too partisan about it, but the Federal Reserve has, its economists have a real strong bias towards what's called the Keynesian types of models, which basically says if you throw enough money at the economy, everything will be just fine. Well, when you throw too much money at the economy, when you've got a shortage of goods and services, that leads to inflation. And so that's the fundamental part of inflation. The other part of it is expectations. And that's what gives rise to this long tenacity of inflation to just stay out there, because once consumers and businesses begin to expect inflation, it's going to persist, and their behavior relies upon that. So it's really taken since the late 70s, really into the early 2000s, and really in one sense into the 2010s before we really got inflation under control. So the expectation that inflation is going to go away anytime soon is not an idea that I can subscribe to. There are three major decision makers in the economies. There's small businesses, there's consumers, and there's large corporations. And this is the National Federation of Independent Businesses Small Business Optimism Index. You can see over time, since it was reset at 100 in 1986, that it's been pretty volatile. It bounces around a great deal. This is the big recession during 2009, the recovery, the strong recovery post the 2016 election. And then it's been on a real decline since then. So small businesses are not real optimistic about things. And one of the major reasons for that is their challenges in finding workers. They also are seeing a lot of price pressure and have been raising prices significantly in the last couple of quarters. And that has historically been a strong indicator of inflation. This is the CEO optimism outlook, or CEO outlook in the red line, along with the percentage change in quarterly GDP. These are the large corporation CEOs and one of the other components. But it's interesting to note that even though the GDP change quarter to quarter has been pretty anemic, the CEOs have been pretty optimistic. And one of the things I think that gives rise to that is that during an inflationary period, large corporations have a great deal of pricing power. And so they're able to pass along those price increases to consumers. And so far, consumers have been pretty willing to bear those costs, but there are some indicators that that's not the case anymore. The Wall Street Journal had a good article on it this week that suggests that there's starting to be some real pushback on these increases, price increases. This is the consumer sentiment index put together by the University of Michigan. And they've been doing this for quite a number of years, going back to the early 1950s. And you can see that it has really plummeted. The blue dotted line is the actual index, and the red dotted line is the index of future conditions, which goes out 1 to 5 years. And this is a trend line. It's got a time series tool that I use that kind of tracks the up and downs of the index. And you can see that consumer sentiment is really taken a drop. And this is as of the end of 2021. Since then, it's fallen even further. And again, since this is 2/3 of the economy, this is a real bellwether for what's likely to happen going forward. And the news, frankly, is not very good. One of the things that is a real challenge in doing this in the economics trade is trying to relate what's happening to the economy to what performance is doing with various asset classes. In this graph, we've got the S&P 500 style size equity index annualized as of the end of last year. And this is the small value through large value, large growth. That's what we mean by style size. So it's value, blend, and growth, small, mid, and large cap. And one of the things that has happened over the last couple of quarters is that value has really taken over from growth as the strong asset class. Small businesses have been doing generally better than large businesses have, which is kind of a trailer of the growth theme. But one of the things that this is indicating is that value types of equities are doing much better than growth, which suggests that growth is not likely to continue. At least that's the way the market sees it. Now, one of the things I like to keep in mind and remind clients of is that the economy and the markets are not the same. Eventually, the markets reflect what goes on in the economy, and in a lot of ways, the markets anticipate what the economy is going to do. But at any point in time, which is what this is at any snapshot, there's a lot of disconnect between what's going on. This is another way of looking at the S&P 500. This is by sector. So there are 10 sectors in the S&P 500: health, technology, utilities, consumer defensive, cyclicals, industrials, natural resources, financials, real estate, and energy. And this is an indicator right here that energy has been the star performer for 2021 based upon the rise in oil prices. I will tell you, as a former energy executive, I have been reluctant to invest in energy stocks for a lot of years, mainly because they haven't exercised a lot of capital discipline and spending money wisely. And as a consequence, they haven't done particularly well. Well, Wall Street has finally realized that capital discipline really matters in this energy business. It's not just a growth theme, and they have been putting capital restraints on particularly the smaller companies. The larger companies have been doing a pretty good job on their own of reining in capital expenditures. And so as a consequence, those that have survived are doing pretty well. One of the things to keep in mind also is that there are some of these sectors that are typically do better in inflationary periods: natural resources, financials, technology to a certain extent. There are others that are more defensive, such as healthcare, utilities, consumer defensive, and those are stocks and equities that have tended to do better when we're into recessionary or economic downturns. So it's going to be interesting to see what happens with those more defensive issues as opposed to the growth issues, such as the financials, industrials, and technology. And technology, for a lot of the last 2 or 3 years, has really been leading the pack, but it's had a tough time in the past. But it really is, I think, in a lot of ways, where you need to be going forward because of the reliance that our economy has had on technology and the contribution that technology has played to productivity. And that's one of the things that has kept inflation under control in the past and may be the silver bullet that can be used to help it in the future. One of the things that I tell people is that you make a bet in any one area and you got a good chance of doing very well. You've got a better chance of losing big time. So this chart is the Callan chart. It's also known as the periodic table of returns, and it basically tracks all of the major asset classes, commodities through investment grade bonds, so fixed income, equity, commodities, and how they have performed. And you can see that they are all over the map. To be able to predict from one year to the next which one is going to do well is, in my view, a fool's errand. So what I recommend is just having a footprint in every sector of the economy that you can, and have a lot of diversification, even among the fixed income assets. It's not a good idea to have just long-term bonds, but have a diverse set of bonds. And in the portfolios that I build, I have as many as 5 different fixed income sectors, asset classes, along with the 10 equity sectors, plus foreign developed and foreign emerging markets. So that's the presentation. Hopefully that's helpful to you. If there are any questions, nobody's raised a hand yet, so ask away.
Hey, Jeff, Larry Kane, thank you so much. That was a great presentation. There's one number that I see up there that I read about a lot that I don't understand, and that's, and it was very obvious in 2 of the slides, the consumer expectations and consumer confidence. I know how you rate equities. I know how you rate rates and growth. That's all number driven. You can get that. But how do they come up with that consumer confidence or consumer expectations number? I mean, how many consumers are there that are interviewed, or where does that number come from?
Well, it's a great question, Larry, and I'm glad you asked that. It's let me just rewind to that so we'll look at it while we're talking here. The University of Michigan has a group of, I believe it's 2,500 consumers that are carefully constructed to represent a broad cross section of household incomes, and they interview the same 2,500 every month, I believe it is. Sometimes they may do it even more frequently, and they ask the same questions. So it's a consistent set of data, and the questions range from how well are you doing now? How well do you think your own finances are going? How well do you think business conditions are changing? And by asking the same questions of the same group of people, there is some consistency that's built into that index. Now, again, it's an index, so they take all of those questions and they have their own proprietary way of weighting those. I don't think that they equal weight them. I think they give some higher weights to some of the questions that they ask, but it's kind of a well-kept palace secret as to how they actually do this kind of stuff. And so you kind of have to take it on faith and look at the big picture of the broad cross section and kind of derive from that what you will. But their track record has been pretty good, and so that's I think about the best explanation I can give you without telling you more than I know.
I've got a couple. First of all, what kind of impact do you think that the rising number of baby boomers retiring is going to have on the medical part of the market? And then second of all, we're seeing a decrease in the small business being as successful as they can be. Do you think that the working from home is easier to do if you are a large corporation versus a small business? And also to the thing about brick and mortar, are we really relying more on corporate from afar or ordering things from afar than we are buying them here at home?
Well, the answer to your first question is it's huge. Baby boomers are becoming ever larger consumers of healthcare, and that's one of the demographics that the smart money is betting on. That healthcare will continue to be a growth industry, in large part because of the demographics, but also because of the productivity of research tools. And as a microbiologist, you probably understand better than any of us, Betsy, how much of an impact supercomputing and software and hardware has made on research and development of new drugs. Insofar as working remotely, I think that's going to be a huge player going forward, and particularly with rising gas prices. We've now demonstrated that we can work remotely, and for people to be out on the road driving to an office in a brick and mortar situation has kind of, I guess, has become less important than it has in the past. Now, humans are social animals and we like to get together and we like to have FaceTime, but when it comes to actually doing work, picking up an extra hour or two a day of productivity is good. Large corporations are probably, and this is a broad statement and it's really not terribly precise, but larger corporations tend to have more of the kind of technology that allows for virtual meetings and virtual collaboration and that sort of thing. Whereas small businesses they're FaceTime. I mean, they're client facing. A retail shop has to have people behind the counter. You know, auto repair place has to have mechanics in the shop. Similarly, small carpentry businesses and small home repair businesses, they have to be on the job. So I think that remote working is probably less important or less of a tailwind for the small businesses and probably more so for large businesses.
George, go ahead. No, I'm not following up. Go ahead.
Jim George Johnson. My memory's being pushed, but I think that in the 70s, we defined inflation with more products and services than we do now. Has that definition changed significantly? And if so, how could you measure it?
Well, it's a great question, George, and the think tanks, the academics have been spending a lot of time in trying to measure a lot of things like what you're talking about, in particular productivity. The one thing that the one long-term secular trend that has been going on here is we've gone from more of a goods and services economy more towards a service economy. And in terms of the number of products, you look at it as shelf keeping units, I would guess there's probably more now than there were back in the 70s. So that when you think about the kinds of services that are available, the kinds of software applications that are available, the kinds of consumer electronic products are a lot greater than they were back in the 70s, when you basically had toasters and refrigerators and rotary dial telephones. So how that's going to impact inflation going forward, if I knew the answer to that question, I'd be sitting on a beach in Hawaii right now.
More questions? No more questions. Quick question then, speaking of brick and mortar, at some point, we're talking about gas prices with keeping people at home. We've also got infrastructure issues that, even though we're throwing money at that, oftentimes aren't going to be able to be fixed. You can only build so much asphalt, and then what? And so I'm wondering if the economy is going to just push itself to being a virtual economy at some point, based upon the fact that you don't really need bricks and mortar. What do you think about that?
I would have to agree with you. More towards it, and a trend towards that, as opposed to getting rid of bricks and mortar entirely. But certainly when it comes to service type work, when it comes to intellectual property type work, I think infrastructure is less important, other than the internet, and having lots of bandwidth and lots of data centers and servers to be able to accommodate that, I think is going to be probably where the growth is in infrastructure. But that's not to say that we aren't going to have repair bridges, because as I was out on my road trip a couple of weeks ago, I was astounded at how many trucks there are on the road. I mean, there's just a lot of goods going all over the place, and rail traffic. I mean, rail traffic has been, in my view, has been very significant. And Jane could tell you more about that than I could, but just my casual observation is that I saw a lot of trains moving.
Sana's got a question. Hang on just a sec.
I've had a couple of millennials in my house for the last week, so forgive this question, but they complain constantly about, well, there's not enough drive-through opportunities for food in a certain area of town or whatever. And I guess I'm kind of puzzled because, here we are with high gas prices, but kids still don't want to get out of their cars ever. To even go inside a brick and mortar business, they want to be able to drive through, pick it up and take it back home. And so I guess from that experience, I'm starting to see sort of a generational thing of where we're going in the future. And what do you see looking like 10 to 20 years ahead?
Oh, well, I think generational preferences are huge. They're about as unpredictable as you can imagine. And your observation, I think, is an excellent one. I hadn't heard that before, but generational preferences for use of technology is huge. I mean, the kids these days are far more adept at that than guys my age are. But yeah, it's going to be interesting to see how all of that plays out, and keeping an eye on what the cutting edge of the new economy is going to look like, because those generational preferences are driving that.
Any other questions? And that's not to mention anything about the international market, but we digress. So thank you, Jeff. We wish you a speedy recovery, and we have a book for you to sign when you get back. So thank you so much. That was very, very interesting and enlightening, and we appreciate you.
Thank you.
Laura, welcome back again. Please come next time too, if you can, as many times as you'd like. We'd love to see you. Are there any announcements? I know Tom Carr has a meeting after this, BRCCF, back in the art room. Julie wants you to sign the pieces of paper on your table and give them to her at the end if you could. Designate somebody from your table to go find her rather than her having to pick them all up. That would be great. I can't think of anything else except the last slide. And thinking about the golf tournament and at all. Is it on there? It's not in there? Okay. It's just a quote that I have, and it's about perseverance. And so perseverance is the hard work you do after you get tired of doing the hard work you already did. Does that make sense? So keep it up. Keep being perseverant as far as Pancake Day is concerned and as far as golf tournament is concerned. And we will see you next week. We are adjourned. Make sure you put the tables up and the chairs up too.